Thank you for joining me to our next Wealth Building Strategies workshop, Multifamily Investing Fundamentals. Why invest in multifamily? If you want to connect with us, review investment opportunities, or just want to reach out, have any questions, you can reach out to us by going to our website, investwithdmi.com, or you can text the word passive to 66866. Let's get started. DMI Holdings was founded in 2008, based here in Dallas. Founded by myself, co-owner of DMI is my partner, Leon Chastain, and DMI provides passive investment opportunities for individual investors. We focus on partnering with quality operators, and currently DMI has completed over $1.5 billion in investment transactions, totaling a little over 100 private placement offerings from 2008 to present. So we're going to talk today about my favorite real estate asset class, multifamily, and hopefully share with you some of the fundamentals and things you should know when looking at investing in a multifamily, whether you're an active investor and acting as a general partner, or you want to be a passive investor. You do need to understand the difference between multifamily and other types of real estate. We're going to talk a little bit about why multifamily, an overview on multifamily investing, how to finance a multifamily property, both debt and equity. Go over a couple of case studies so you can get an idea of what a real live multifamily property looks like. So multifamily investing, why real estate? So real estate creates more wealth than any other industry in the United States currently. It's one of life's three basic necessities. People need to eat, people need water, and they need a place to live. So housing is a great place to invest your money because it's something that everybody needs. Some people can't afford a house or choose not to buy a house. Therefore, their other option is to rent. If you look at the wealthiest 1% in the United States, 74% of the wealth is held between business owners and real estate investors. So here's one of the advantages to a real estate investment that you can't do with, for example, an investment in the stock market, especially with mutual funds. So let's just look at this simple example. Assuming a $20,000 investment. On the right, if you invest $20,000 into a mutual fund and you receive a 15% annual return on investment, that means that you earned $3,000. If you compare that to a real estate investment, you put down the same $20,000, you get a loan for $180,000. You get only a 5% return. Your actual dollars you make on a 5% return is $9,000. Why is that? It's because you're able to get a leveraged return on real estate, whereas you can't do that, for example, with a mutual fund. So your 5% return is on the entire value of the property versus just the cash that you invested. So let's look at single family versus multifamily. Multifamily, you get better leverage for your time and capital. There's maintenance and operational efficiency. So what that means is, imagine owning 100 single family rental properties. Even if you have a property management company, generally you're going to charge you 100% of the first month's rent and 10% of rents collected. There are other services out there. But even though it's being managed, it's still going to be a headache to you. You're still going to be contacted on a regular basis because of issues going on at all of these individual properties all over your marketplace. Versus on a multifamily property, you're going to have professional management on site. You could have 100 to 400 units. A 100-unit property costs the same to manage as a 50-unit property. You're going to have a property manager on staff. you're going to have a leasing agent on staff and a maintenance person or persons on staff, depending upon the size of the property. And so you really get a lot of bang for your buck. Also, from a management standpoint, your property management company, depending upon how many properties you have, is going to charge you as much as 6% instead of 10, and could charge you as low as 3% if you have multiple properties that your property management company is managing for you. You get higher cash flow per unit, and multifamily, which we cover in a different presentation, has what's called forced appreciation, versus single family homes have natural appreciation and depreciation, meaning that the value on a single family home is simply dictated by the buying and selling activity in any given market. On a multifamily property, the value is dictated almost solely by the income that it generates, which means that you can control the return that you have on a multifamily property and the amount of cash flow that you get, whereas you cannot do that on a single family home. And there's less competition. Every Tom, Dick, and Harry are out there buying fix and flips, single family homes. You have a lot less competition buying assets that are in the $10 million to $30 million range. So quick overview on multifamily investing. There are different classes of properties that you'll hear: Class A, Class B, Class C, and Class D. A lot of these are not hard and fast rules, but a Class A property is basically new construction or a property that is 10 years old or less. And you're generally, the people that live in Class A properties are renters by choice, not by necessity, meaning that these people could afford a single family home. They're choosing to rent. Class B is generally in that 10 to 20 year range. However, there are properties that may be a little older than that you go in and do a value add to improve the property. Also has to do with the tenant profile and the kind of occupations they have. But a Class B property and a Class C, you can add value. There's a lot of upside on those kinds of assets. Class D properties, those are old. They're in bad neighborhoods. We don't do them. I recommend you steer clear of Class D properties unless you're a developer and you're basically going to build a new property, but you might as well just do a new construction versus go in to a D class area and try to turn it into a Class A. That's not a great model. So unit mix, you want to have 2 and 3 bedrooms. You don't want to have too many 1 bedrooms and only a few 2 bedrooms. You want families living there. They're going to stay there longer, take better care of your property, that type of thing. Generally, you want pitched roofs. That doesn't mean we've never done flat roofs, but you generally have more roof problems with flat roofs. So we prefer pitched roofs. And we also prefer individually metered, where everybody's responsible for their utility bills versus all bills paid. Because if they're not paying their electricity bill, they'll keep their AC on 68, open up all the windows 365 days a year. They don't care because they're not the one footing the bill. So we generally don't do all bills paid. So there's different ways to analyze a property before you buy and determine the value. There's the sales approach. So there's 3 basic ways to determine your price. Sales comparison approach is where you're comparing similar properties that have sold, usually within the last 6 months, within a certain geographical radius from the subject property, generally no more than 3 miles. That's your sub-market that you're looking at. The second way to determine value is the replacement approach. So the replacement cost approach, it determines the value by calculating how much it would cost to replace the existing structure today. So if what you're buying it for is less than what you could build it for, then you're purchasing it below replacement costs. That's a key indicator when you're buying an existing property. They aren't building any new 1970 properties buildings anymore. So know what you're paying for each building per square foot. And then the third the value determination is the income approach. And this is where you look at the income on the property. So the income approach, you're going to look at the net operating income, which is the income minus the operating expenses. So net operating income does not include debt service and does not include capital expenses. And you're going to look at the cap rate, which is the net operating income divided by the purchase price. And then why are cap rates useful? Just for example, if you took $100,000 a year income, or you had $1 million a year in income, and the property you're buying it for $10 million, you take $1 million divided into $10 million, and that's a 10 cap, for example. If it's generating $500,000 a year, that is a 5 cap that you'd be buying it for. So generally, you want to buy it on a higher cap rate, sell it on a lower cap rate. So why cap rates are useful is that it assumes you're paying 100% cash, which then eliminates the differences in down payments across various buyers. So cap rates are a little counterintuitive. So as the cap rate goes down, the properties are appreciating. As the cap rates go up, the properties are depreciating. You also need to master your market. So if you're just buying properties all over the place and you don't have a good fundamental understanding of the markets that you're buying in, then you could get yourself into trouble. So why do you need to master your market? You want to build a reputation for being the person in your market. Pretty much all of the properties that we get, they're brought to us versus us going out chasing them down. This just leads to greater deal flow and quality of deal flow. One thing I will mention is that it's better to not do a deal than do a bad deal. So generally, for every one multifamily property our investor network would have an opportunity to invest in with us, we've gone after, looked at 100 properties, analyzed about 20 of them, went in, did full underwriting on 10, put in letters of intent on 5 with the hope that you're going to have one that's going to your bid will get accepted. It's also a way to protect your downside, and it protects yourself from investing in a declining area by knowing what's happening and where economically, politically, sales and rental comps and things of that nature. Acquisition criteria. So there's good places to buy, bad places to buy. And again, you can do A, B, and C class multifamily properties. Generally, we look for properties that are 1970s or 80s or newer. Average deal size, 100 to 400 units. And you want to be in major metro areas with good visibility and nearby freeway access. And another thing that I would say is a key thing is to be close to elementary schools, because it's going to bring in more families. That is going to keep them there longer term. And so in Texas, for example, although we invest in other states, your major metro areas are Dallas, Houston, San Antonio, and Austin. That's called the Texaplex, the Texas Urban Triangle. So really, those are your main areas. And why is that important? A lot of it has to do with management and access to good quality management. If you're in a small town that's not a major metro area, it'll be more challenging to find good quality staff for your property, just because you have a smaller market. Next thing is due diligence. Why do it and what do you do? So why is due diligence important? So this is where you prove to yourself you're buying what you thought you're buying, or you make adjustments as appropriate if it's not. So what is due diligence? It's the process of validating all available data to determine if you indeed have a good investment opportunity. Here's the main parts for doing due diligence: physical inspection, financial inspection, looking at the income and expenses. You're going to do a market inspection and look at your submarket, sales, and comps for rents. If you buy an existing property and the property's average rental rate is 200 units, Class B, 20-year-old property, and that property is charging an average of $1,000 a month. And your submarket with similar properties, unit-wise, age-wise, is charging $1,200 a month. You know, you have a lot of room to grow your rents, and your objective would simply be to just get your current rents at $1,000 up to what the submarket's already willing to pay. And that is a conservative way to estimate your value. And normally you can do that in about 2 years. But a lot of times you'll run a pro forma where that occurs over a 5-year period of time to be conservative. But if the submarket's paying $1,200, your property is being mismanaged, mom and pop owned, they're only charging $1,000, they're not pushing their rents up, you know, with relative certainty, within at least 2 years, you should be able to get up to just where market rates were at the time you bought the deal. And then you need to review all their contracts that they have in place, how long they are, who they're with, what they're paying for them, because there's other ways to increase value immediately, which we'll cover in a separate wealth building strategies workshop on multifamily returns explained. Then the next thing is your property management. You must have good quality property management. You need to interview them. If you're working with a new one, you find out how big they are, how many units are they managing altogether, what are they managing? Are they managing multifamily, or are they also doing single family? You typically want property management company for a multifamily property that's all they do. Are they managing property? You're buying a 200 unit property, but their average property size that they're managing is 20 to 50 units. They're not qualified to manage your 200 unit property. So you're going to look at all of those things, number of units that they're, what box do they manage in? And you want to make sure your property fits in their box. What type of properties that they're managing? Are they managing Class A, Class B, Class C? Because if you have a property management company that's used to managing Class A and those kinds of tenants, and then you want to hire them for your Class C property, completely different tenant profile, completely different neighborhood, you could really be getting yourself in trouble because it's just not in their wheelhouse. And then also the locations. Are they managing other properties in your area? And if they're not, that's a red flag. And if they are, then you want to actually go and look at and analyze those properties at the time they took over, how they've done, and that will help you make the best property management decision you possibly can. So let's talk a little bit about entities. There's another wealth building strategies workshop, understanding the entities to use for investing. This is just super high level here, but you want to make sure that you are protected. You have asset protection. So generally you're going to use an LLC, limited liability company, or an LP, a limited partnership. Do not hold real estate in an S Corp or a C Corp, and do not hold real estate in your personal name. There's direct liability to you if you hold property in your personal name. And the reason for not using an S Corp or a C Corp is you're going to lose out on a lot of the significant tax advantages, which we also cover in a separate presentation. So general benefits, LLCs and LPs, is that it's the most popular entity to hold real estate, and it provides the best of both worlds. You get the flow through tax benefits from the property, cost segregation, bonus depreciation deductions, passive rental income, all that stuff carries through to the LP investors. And then you also get the limited shield of a corporation. So you are protected. You're not liable as an investor at the property level, which is also very important. So it can shield you from those liabilities. Some additional benefits is that you have corporate veil, but the corporate veil can be pierced. So you must run your multifamily property like a business. The only activity that goes on financially inside that LLC has to do only with that property. You need to keep separate bank accounts. Don't commingle funds with other properties. you can get into some serious trouble on many different levels operating your business that way. So just follow the rules required by the entity, which will be in your operating agreement, and then you hold minutes when you have your meetings. And in general, you want to hold one apartment per entity. That doesn't mean that you couldn't invest in a fund that invests in multiple properties. That's called fund of funds investing, which we also explain in a separate presentation. But the fund isn't investing in multiple properties directly. Each property is owned by an LLC, and the fund would be investing in the property LLC. So each property needs to have its own independent LLC. So financing is part of how you're going to take possession of the property. And so financing basically falls in two buckets. You have debt and you have equity. So just some quick terminology here on debt. There's different kinds of loans. There's recourse and non-recourse. Most multifamily acquisitions are non-recourse loans. Most construction loans are recourse loans. That doesn't mean you can't do an acquisition with a recourse loan, and it doesn't mean you can't do a construction project with a non-recourse loan. I'm not going to go into all the details, but in general, this is the two types of loans. And you'll have what's called bad boy carve-outs in the loans. Basically, they're covenants of the loans that you need to follow so you don't go into default, which would directly fall on the liability of the signer, not the limited partner investors. When you do a loan, there's generally points that are charged, typically 1% of the loan. It can be greater, depends on the loan type. There's third-party fees, yield maintenance, which is prepayment penalties. Sometimes you want to refinance out of a property in 3 years, but you have yield maintenance and prepayment penalties that burn off over that 5 years. So if you refinance out early, it could cost you a lot more and may not make sense to refinance early. So you really want to be careful and make the right loan choice going in on the front end. If you're going to do a value add acquisition strategy, in most cases, you want to do an interest-only commercial bridge loan. And that allows you to refinance and get out without penalty at any time during the term of that loan. That's generally what we do. Sometimes a property will come with a loan that has to be assumed. So there are a few caveats to that, but regardless, that can cause problems. And we've had those situations before. You have prepayment penalties in addition to prepayment fees. And so there's different types of loans, Fannie Mae, Freddie Mac. These are permanent loans. There's bank loans, CMBS, commercial-backed mortgage securities. There's bridge and rehab loans. Those are generally used to do an acquisition strategy. If you're going to come in and add a bunch of value and then you want to put a permanent loan on there and do a cash out refi, you might use a commercial bridge loan. We typically do that on value add deals. You can also get seller financing, which we've done many times. And the seller might be willing to carry back some of the financing while you're doing your value add strategy. And maybe you're assuming a loan that they had, and then they seller finance you and allow you to do your value add. Then you refinance out and you take out their seller finance loan. There's a number of different ways you can skin the cat. And then there's private loans. You can also do hard money loans. It just depends, but it's expensive and depends on how the condition of the property. If it's a highly distressed property, super low occupancy, and you're basically going to be vacant for a year or something like that, you're not going to get a loan from most of the sources above. That's where we've done this a number of times, and but you generally have a very short time fuse, 12 months, 18 months for you to be able to replace it once it's stabilized. So we typically don't do distressed value add multifamily. We do stabilized value add multifamily because there's less risk and you don't have to use hard money. So just a quick example on debt financing. A loan to value example is if your purchase price is $2 million and you get an 80% loan to value, I would tell you, even if the bank's willing to give it to you, you don't want to go over 80% loan to value. That would mean that you would need to bring $400,000 in equity from investors to close on that $2 million purchase. And just a couple of other examples. So if you get a 75% loan to value or a 70% loan to value, the loan to value you get is going to be dependent upon the past performance of the property and the comfort level of the lender. So your purchase price minus your loan equals the equity that you need. So on your 70% loan to value, that means you would need to bring $600,000 in equity. Debt is a double-edged sword. You don't want to be over leveraged, but the more debt you can get, the less equity that you invest. You're paying a return to your investors based on the equity that they invested. So if you get an 80% loan to value and you only need $400,000, the return to those investors could be greater than the 70% loan to value example, where you're putting in $600,000 and you're now paying a return on more equity. And so your equity partners is basically you're giving a percentage of ownership in exchange for cash. There's a lot of different ways to structure deals. And again, this presentation is very high level. We're not going into deal structuring on this. It's just general knowledge. So in most cases, you're typically going to work with accredited investors that have a $1 million net worth or greater, excluding the personal residence, and at least $200,000 in income. It's either or. So you could be accredited by net worth, you could be accredited by income, or filing jointly, it would be $300,000. And then you just need to make sure you always consult with a securities attorney just to be in compliance with the SEC regulations on investor types and how you market your properties. So we try to follow the 3 money laws on a property. So you want to make money now, meaning that you're buying it preferably below replacement cost, and hopefully it has a strong cash flow. So buying stabilized value add multifamily deals generally ensures that you're making a solid purchase going in the door. And then once you have the property stabilized, you want to be able to distribute cash so that there's income that is produced off the property. That can sometimes occur in year 1. Sometimes it will take 2 years to get it stabilized, but generally within 2 years, you should have a cash flow, and it can start as low as 3, 4, 5%. And it can also go up as high as, 10, 12%. Until you refinance and you're able to pull equity out, and then it can be, significantly greater than that. And then money in the future, and that's your profit on sale when you go sell the property. And the nice thing about multifamily is, again, you have forced depreciation. You can reduce your expenses and increase your income, which is how you make your profits on a multifamily investment. Just a couple of quick case studies. This is just a property in Memphis, Tennessee. It's 321 units, acquired in December 2017 at a purchase price of $6.8 million. The project value increase was $2 million. And so this was a large value add opportunity focused on rehab and property transformation, increased the occupancy from 68% to 96% in 8 months. Net operating income increased by $40,000 a month within eight months, and then refinanced after 15 months, returning 87% of the investor equity while still maintaining ownership of the property, and then ultimately was sold and generated 128% total overall return to the investors. This is another property in Atlanta, Georgia, purchased for $4.7 million. This was a net operating income increase opportunity focused on rehab of the unit interiors and operations improvements, and increased rents $180 to $200 a month above the pro forma. Property was then sold in January 2021 for $9 million. Investors doubled their money over that period of time with a 30+% IRR. most multifamily properties, our target return for investors is to double their money in 5 to 6 years, and hitting a return on investment target per year of 10% to 20% per year. That is the typical box that a deal is going to fall in for us to want to move forward on the investment. And with that, I want to thank you for joining us for our current wealth building strategies workshop. I hope the information that you received was helpful to you. If you want to connect with us, learn about investment opportunities, become part of our professional investor network, you can connect with us several ways. You can text the word passive to 66866, or you can go to our website, investwithdmi.com, and check out our website and reach out to us there. And you can also email invest@dmi-mgt.com, or you can call. Please feel free to reach out. We'd like to talk to our investors. The phone number on the bottom there is 972-239-5766. Thank you so much for joining me, and I look forward to seeing you on our next wealth building strategies.